Hello everyone. So we are back with the next revision video on financial statements of companies, which is in your third module. Okay, this chapter is more format or memory oriented. Yes, slightly accounting intelligence is also required to prepare a proper balance sheet P&L. But in my view, what is more important is complying with the format given in schedule 3. Okay, so first what we will do, we will go through the format of balance sheet and P&L as given in schedule 3. We will understand each and every line item first. We'll quickly revise that, and then there are certain interesting adjustment in the ICA study mat questions. Those interesting adjustments I'll be helping you out so that you can easily solve and prepare the balance sheet and P&L. I hope already most of you will have a knowledge about what should come in balance sheet, what should come in P&L. It is same as what you have prepared in your foundation or in your 11th standard with respect to trading P&L balance sheet for a sole proprietorship, the same way. But only thing is, since it is a company, we have to follow a specific format which is given in our schedule 3. Okay, so let's quickly go through this format in detail. We'll be going through balance sheet, P&L, as well as what should come in notes to accounts as well. Okay, so first one, in the balance sheet, we will start with equity and liabilities. Always under schedule 3 IGAP balance sheet, it will be first equity, then liabilities, then only assets will come. So equity and liabilities. Under equity and liabilities, first thing that we have is shareholders funds, which is owners funds. This will have share capital as well as reserves and surplus. So let us do one thing. Along with share capital, let us finish this note 1 also, so that we will know what needs to come under share capital. Okay, here share capital means both equity share capital and preference share capital. So the total of equity share capital and preference share capital only should come in the balance sheet. Okay, so first one, share capital. That's why I've written clearly equity share capital, we will give separate disclosures. Same thing will apply even for preference share capital as well. So whatever I have written here for equity share capital applies for preference share capital also. So in the question, if you have both equity share capital as well as preference share capital, ensure that you write the same disclosures separately for equity share capital and separately for preference share capital. So first we have to write about authorized capital. I hope you would have already learned about authorized capital in law and also in many other chapters. Authorized capital is the maximum capital that the company is authorized to raise. That is the maximum amount that they can raise. If they have to raise beyond that, then authorized capital should be modified by contacting register of companies. So this is authorized capital. This is the maximum capital that the company can raise. Please understand, there will not be any journal entry or accounting for authorized capital. Authorized capital is just a statutory number. There is no journal entry for this. Don't go and search authorized capital ledger account. No, that won't be there. This is only for disclosure purpose. What is very important for us is issued capital, because only those shares that we have issued, for that only we should pass journal entry. So first mention how much is the authorized capital. That information will be given to you in the question. You are not expected to calculate. You cannot calculate also. So authorized share capital information will be given to you in the question. Then with respect to issued capital, we have to say how many shares we have issued and what is the called up value. Remember, always what will come here is not the paid up value, called up value. Guys, I would have told in the class itself, the equity share capital ledger account balance will show called up value and not paid up value. So first write the called up value here. If you have fully called up, it will be 10 rupees. But if it is partly called up, sir, I have called up only 8 rupees or I have called up only 5 rupees. In that case, how much ever amount you have called up, write that there, and that number of shares into that amount called up will give the total called up value. And if there is any calls in arrears, that means the amount that has not been received, that calls in arrears should be subtracted. So from called up value, if you subtract calls in arrears, you will get paid up value. Okay, so this equity share capital called up value will be in a separate ledger account and calls in arrears will be in a separate ledger account. But for the purpose of presentation in the balance sheet, this equity share capital ledger account will be subtracted with this calls in arrears. Net amount, which is the paid up value, will only come on the face of the balance sheet. And then to this, whatever shares you have forfeited, you remember you would have learned in foundation, also in 12th standard company accounts, whenever the shareholders don't pay the call money, then the directors will forfeit that share. So whatever shares have been forfeited, the paid up value on those shares will be in the share forfeited account balance till the time those shares are reissued. Remember this point. Paid up value on the forfeited shares will be there in the shares forfeited ledger account till you have reissued these shares. So whatever balance is there in that ledger account, that also will be added. This total amount, this minus calls in arrears plus shares forfeited balance, this only will come in the face of the balance sheet. Okay, so be very clear with this. And also one specific schedule 3 requirement for disclosure purpose. What schedule 3 says is, in these, out of this total number of issued shares, you have to tell how many shares you have issued for consideration other than cash. That means you have to write those number of shares for which you have issued those shares, but you have not received cash. You have received something else. For example, you have purchased a plant and machinery by issuing shares. You have purchased land and building by issuing shares. You have purchased furniture by issuing shares. You have received something else in return other than cash, or you have issued fully paid up bonus shares where you will not receive cash itself. Those cases should be separately disclosed. Companies Act wants you to tell to the users how many shares you have issued for a consideration which you have received other than in the form of cash. Those number of shares should be separately disclosed. I hope you are clear with this. This disclosure should come separately for equity share capital and separately for preference share capital. Let us go to the second one. Then the second one is reserves and surplus. All the reserves will come here. Let us see what all reserves can be there. One, obviously many of you know, securities premium reserve. Here the premium will be there. Excess of issue price over face value, which is a premium, will be there inside securities premium ledger account. And then you all know revaluation reserve, AS10. We would have learned this. Any profit arising on revaluation of an asset under AS10 cannot be taken to P&L, will be transferred to a separate reserve called as revaluation reserve. So this revaluation reserve also will come here. General reserve will also come here. Capital reserve will come, and if you have even CRR also will come as a part of this reserves and surplus. CRR, I hope you know, capital redemption reserve. Basically any reserve will come under this heading. And then we will also have our profit and loss balance. Guys, if you remember, I have told several times in the class, this is P&L personal account. This is accumulated profits, not a single year profit. So P&L personal account, see what is the opening balance. To that add the current year profit. If it is loss, you have to subtract. So add profit or subtract loss, and then whatever appropriations are there, if you are transferring to any other reserve, that will be subtracted. Any dividend declared also will be subtracted. Remember, dividend is an appropriation. It won't come in P&L nominal account. It will come in P&L personal account. So this dividend that you have declared should be subtracted from the P&L personal account. The remaining is only the balance that will come as a part of reserves in the face of the balance sheet. So this is the first section, which is the equity section. In equity section, we will have share capital and reserves and surplus. Share capital will have both equity share capital as well as preference share capital. In that, remember to adjust calls in arrears and shares forfeited account balance. Okay, and then we will have next non-current liabilities. Remember, non-current liabilities are those liabilities which are payable after 12 months from the balance sheet date. Something you are going to settle after 12 months from the balance sheet date, that liability will be called as non-current liability. Any liability which you are required to settle within 12 months from the balance sheet date, that will be called as current liability. So under non-current liabilities, we will have long-term borrowings. These borrowings are repayable after 12 months from the balance sheet date. So here what is important is greater than 12 months from the balance sheet date. That is very, very important. This is less than or equal to 12 months from the balance sheet date. This is also very, very important. You should know what should come in current liabilities, what should come in non-current liabilities. Under current liabilities, we have the next one, which is long-term borrowings. Let us go to note 3 and see what is there in that. So under long-term borrowings in note 3, first important thing is, guys, this needs to be split between secured and unsecured loans. That means secured loans should be disclosed separately in notes to accounts. Unsecured loans should be disclosed separately in notes to accounts. So now what is secured? What is unsecured? Secured means there is a protection given to that particular lender. For example, you would have learned in your law chapter called charge. So whenever you are borrowing a loan from somebody, assume you have given some of your assets as security. So there is some security for the lender. Such type of loans borrowed are called as secured loans. But if you are borrowing something without giving any security, without giving any of your asset as security, or without any guarantee being given for that loan, then that loan will be called as unsecured loan. So you have to split between how much is secured loans, how much is unsecured loans. Sir, what are the different types of loans that can come here? Debentures can come, bank loan can come, loan taken from any financial institution can come, and if these loans, if you have given any security by hypothecating your asset, I hope you know these terms, hypothecation, pledge. So your asset will be given as a security. Now, appo you have to mention in the bracket what is the asset that is given as security for this particular loan. That should be mentioned as a disclosure in the bracket. And if any loans you have borrowed from directors, that should also be separately disclosed. Any loans from related parties should also be separately disclosed in the notes to accounts, not in the face of the balance sheet. In face of the balance sheet, we will have the total long-term borrowings. In notes to accounts, we have to show this separately. Okay. And the next one after long-term borrowings in the balance sheet will be trade payables. You all know it is the normal creditors. Okay. See, practically when you are preparing a balance sheet, this trade payables will be split into how much is payable to MSME and how much is payable to non-MSME. MSME means micro, small and medium enterprises. Okay, so practically if you have to pay some amount to a micro, small or medium enterprise, that needs to be disclosed separately. And if you are paying something to non-MSME, that is large enterprises, that needs to be disclosed separately. But really ICA has not tested much on this in any of the questions. Okay, and then short-term borrowings, note number 4. Let us go to short-term borrowings, note number 4. Here there is one important point which I want to tell you. Under short-term borrowings, what will come is, if you have taken any loan which is payable within 12 months, that also will come under short-term borrowings. There is one more thing, very important thing. Current maturities of long-term debt. Current maturities of long-term debt. Let me explain you what is this current maturities of a long-term debt with an example. Okay, assume you have borrowed 50 lakhs loan from SBI. Okay, assume you have borrowed on 31st March 2025. And this 50 lakhs loan, you are required to pay in 5 installments. Okay, of 10 lakhs each. You are required to pay in 5 installments. The first installment will start from 31st March 2027. I repeat, you have taken a total loan of 50 lakhs from SBI. You have taken that loan on 31st March 2025, and this 50 lakhs is repayable in 5 installments, and those 5 installments will start from 31st March 2027. On 31st March 2027, first installment will be paid. On 31st March 2028, second installment will be paid, and so on. It will keep continuing. continuing till you finish this loan. Now if you see, listen carefully. When you are preparing balance sheet as that 31st March 2025, this entire 50 lakhs, you are required to pay only after 12 months from the balance sheet date. Because 12 months from the balance sheet date is actually up to 31st March 26. 31st March 26 வரைக்கும் நீ எதுமே பே பண்ண வேண்டாம். Nothing is required to be paid till 31st March 26. Your first installment itself starts on 31st March 27. That means when you're preparing this 31st March 2025 ka balance sheet, in that this entire 50 lakhs loan will be shown as long-term borrowings under non-current borrowings or non-current liability. This will be shown as a long-term borrowings. Remember that this will come under long-term borrowings. Is this clear? Now this is okay, fine, sir. When you're preparing 31st March 26 balance sheet, this is where it gets interesting. Ensure you listen to this point carefully. When you're preparing the balance sheet on 31st March 2026, what you should do is, see, listen carefully. You have a total loan of 50 lakhs. Out of this total 50 lakhs loan, 10 lakhs should be paid on which date? 31st March 27. Remaining 40 lakhs you will pay in 4 installments from 31st March 28. So what happens when you are preparing 31st March 26 ka balance sheet? 10 lakhs is payable within 12 months, which is 31st March 27. So in 31st March 26 balance sheet, this 10 lakhs will be shown under short-term borrowings, and we will call it as current maturity of long-term debt. This is a long-term debt. Out of that, one portion is payable within 12 months. That portion is called as current maturities of long-term debt. Remaining 40 lakhs, which is actually payable after 12 months, that will be shown under long-term borrowings. Hope you have clearly understood this. So ensure that you show this perfectly as current maturities of long-term debt. Okay. And here one point that you should remember, what you show under borrowings, be it debentures, loan, financial institution, directors, related party, current maturities, all these guys will be principal amount. Only principal amount will come here. If you are going to pay any interest and that interest is outstanding, that interest payable or outstanding interest will come under other current liabilities. Remember to listen to these points carefully. All the points that I'm telling you are adjustments in any of the questions asked in ICS study mat. Okay, so only the principal portion will come here. The interest portion which is payable or outstanding will come under other current liabilities. So ensure you are very clear with that. This is there in one sum in ICS study material. Okay, and so this is on long-term borrowings and short-term borrowings. In short-term borrowings, please remember that point on current maturities of long-term debt. Moving on in the balance sheet. Then we have short-term provisions and other current liabilities. Let us see what is given in note 5 and note 6. Note 5 is short-term provisions. Note 6 is other current liabilities. Under other current liabilities, we have our outstanding expenses, interest which we have accrued but it is not yet due for payment, due date for payment has not yet come, and whatever dividend payable is should also come under other current liabilities. Guys, remember, dividend payable is different, unclaimed dividend is different. Sir, what is the difference, sir? Dividend payable is you have declared the dividend but you are yet to pay it to your shareholders. The journal entry for this is P&L personal account debit to dividend payable account. P&L personal account debit to dividend payable account. And then this unclaimed dividend means, sir, what is this unclaimed dividend means? See, unclaimed dividend means company is ready to pay to the shareholders, but they are not able to find those shareholders. Those shareholders are not coming and claiming the dividend. So that portion of dividend is called as unclaimed dividend. Dividend payable means company has declared. You would have learnt in law, once the company has declared, if my memory is right, don't judge me if that number of days is wrong. Okay, this is what I remember from my memory. Once the company has declared dividend, within 30 days they have to pay to the shareholders. So till it is actually paid, it will be under dividend payable account. Now I am ready, company is saying I am ready to pay, but the shareholder is not traceable, he is not claiming the dividend. That portion will be in unclaimed dividend. If my memory is again right, this unclaimed dividend will be kept by the company for a few years, and after that they will transfer it to Investor Education Protection Fund, IEPF அப்படின்னு படிச்சிருப்ப லால ஷேர் கேபிட்டல் அண்ட் நோ சாரி டிவிடெண்ட் சாப்டர்ல. Okay, so that is what is this dividend payable and unclaimed dividend. Okay, so we have completed successfully the liabilities, equity and liabilities section of the balance sheet. Now let's go to the assets part of the balance sheet. Again, assets are divided into non-current assets and current assets, where your benefits will be received within the next 12 months. Those are called as current assets. All the other assets are called as non-current assets. Under non-current assets, the first one which you all know, PPE, property, plant and equipment, AS-10. And then you should show intangible assets including goodwill covered by AS-26. And then you have to show non-current investments. Remember in AS-13 we would have split investments into two, current investments and non-current investments. So non-current investments should be, actually it is governed by AS-13. This also should be shown. So under non-current assets, PPE, intangibles, non-current investments, any other non-current asset is there na, that also you can show it as other non-current asset. Okay, so this also you remember. Let us once see what is there in note number 7. Okay, in note number 7, property, plant and equipment, how we have to disclose this? We have to disclose the same way even for intangible assets. Okay, same disclosure will apply. First, take opening gross block. Always remember guys, Companies Act wants you to show the original cost separately, accumulated depreciation separately. Companies Act wants it to be disclosed in notes to accounts. In the gross block you are seeing, no, this gross block is nothing but original cost. So you should say what is the original cost at the beginning of the year. Add additions. Sir, what is this additions? Additions means PPE purchased during the year. Less disposals. This is PPE sold during the year. Remaining will be our closing gross block or closing original cost. Then again you should show the accumulated depreciation separately. You should say how much is the opening accumulated depreciation, and whatever is the depreciation for the year, that will be added to the accumulated depreciation. And remember, we would have learned this in depreciable assets ledger account. In respect of any asset sold or scrapped or destroyed, whatever depreciation that has been charged, whatever accumulated depreciation that has been charged on the asset will be transferred from accumulated depreciation account to asset account. That also should be subtracted here, and then you will get closing accumulated depreciation. This original cost minus accumulated depreciation will actually give you the WDV of this PPE. This is also called as net block. This closing WDV only will come in the face of the balance sheet. Hope you are clear. Same way you should also disclose for intangible assets. Okay. Next, let us move to current assets. Under current assets, we have trade receivables, which you know is debtors. First, we will just see these 4 items and then I'll take you to the notes. And then we have inventories, which is our AS2, cash and bank balances. This also includes cash equivalents. Guys, remember we would have learned this in AS3. So cash and bank balances, including cash equivalents, and then any short-term loans and advances that you're given to somebody will also come here. And if there are any other current assets, you can also show it as other current assets. Okay, so this is on current assets. Let us see the notes. Trade receivables is important. Trade receivables note. Okay, tested multiple times in multiple questions. So remember this. Debtors, whatever debtors is due for a period of more than 6 months. That means, guys, remember, assume I sold goods worth 10 lakhs to Ram. I sold it on 1st April 2025. Okay. And I gave that Ram 90 days time to make payment. This 90 days time to make payment is called as credit period. Is called as credit period. That means I sold to him goods on 1st April 25 and I have given him a time of 90 days, which means 3 months, April, May, June. So he should pay me on 30th June 2025. This is the due date. This is the due date. Okay. But when I go and ask on 30th June 2025, Ram is telling, give me some more time, give me some more time. Like that, Ram is dragging. When I am preparing balance sheet on 31st March 26, this 10 lakhs, Ram has not yet given me. It is still receivable from Ram. Now, if you see, actually this 10 lakhs was due on 30th June 2025 itself. அன்னைக்கே அவன் இந்த 10 லட்சம் கொடுக்கணும். ஆனா even till 31st March 26, this Ram has not given us. That means it is due from 30th June, July, August, September, October, November, December, Jan, Feb, March. மொத்தமா it is due for a period of 9 months. So this is a debtor which is due for more than 6 months, that needs to be disclosed separately, and other debtors which are due for less than 6 months, that should be shown separately. Less than or equal to 6 months should be shown separately, and whatever PDD, provision for doubtful debts, you have created, that should be subtracted. This net amount, this plus this minus this net amount only will come in the face of the balance sheet. Is this clear, everybody? Okay, so ensure you remember this. This debts due for a period of more than 6 months is asked in multiple questions. Okay, actually, if you read the latest amendments that has come in Schedule 3, they want a different type of disclosure for debtors. They want us to give aging. They no longer want the 6 months. They want us to give aging. Like they want to say how many debtors are due for less than 6 months, how many in 6 to 12, how many in 12 to 24. Actually, that is the latest disclosure requirement that is required by Schedule 3. That disclosure requirement is given in theory in your book, but it is not followed in any sum. Okay, in some still he is following this old disclosure requirement only. So in the exam also, if he is asking you this, if he is giving you this debts due for more than 6 months, show it separately in notes to accounts. But in my view, this is already amended, but the questions in your study mat have not been amended. Okay, and then inventories, you all know inventories, we have finished goods, work in progress, raw materials, all those should be shown separately. Now, important disclosure for cash and bank balances. Covering cash and bank balances, we should show whatever cash we have in hand and whatever cash is there in bank. Whatever cash is there in bank, that needs to be split between how much cash is there with scheduled banks, how much cash is there with other banks. Sir, what do you mean by scheduled banks, sir? Okay, we need not go into very detail. We are not learning banking law here, but scheduled banks means these are banks which are listed in second schedule of RBI Act 1934. RBI Act 1934 ல ஒரு schedule 2 இருக்காம். அந்த schedule 2 ல whatever banks are listed, those are scheduled banks, others are not scheduled banks. Now for the scheduled banks, RBI will give some privilege. RBI has more trust in the scheduled banks because banks are very important for an economy. So RBI should have trust in that. So whatever banks are listed in second schedule of RBI Act, those are called as scheduled banks, for which there are more privileges. RBI has more trust for those. Other banks are called as non-scheduled banks. So, sir, how will I know whether a particular bank is a scheduled bank or not? Don't worry, they will tell you in the question whether this is a scheduled bank or not a scheduled bank. Adukku sir na ukand schedule 2 open panni dabaditoma ella scheduled banks thevaye illa. They will clearly tell you what is whether this bank is a scheduled bank or not a scheduled bank. In that case, whatever balance is there with scheduled banks, show that separately. Whatever bank balance is there with other than scheduled bank, show that separately. And then cash equivalents, you would have learned today. Cash equivalents are short-term, highly liquid, marketable securities that are due for a short period of time. That 3 months that are readily convertible into cash. And the 3 months kulla convert on the cash equivalents. Short-term, highly liquid, marketable securities. You would have learned this definition in AS3. Those cash equivalents also will come here. And any other bank balances, this will be your FD bank balances which have a maturity period of more than 3 months but less than or equal to 12 months. Sir, yes sir, less than or equal to 3 months is la varada sir. No, less than or equal to 3 months will come in cash equivalents. Remember, we will discuss this in class also. A fixed deposit which has a maturity period of less than or equal to 3 months will come in cash equivalents. Okay, any fixed deposit having a maturity of greater than 3 months and less than or equal to 12 months will come in other bank balances. Sir, what about FDs which have more than 12 months of maturity? They will come under non-current assets. You will show them as non-current assets because they are receivable after 12 months. So they are not current assets. They have to come under non-current assets. Okay, next one. Short-term loans and advances. If you have given any loan to directors, you have to show separately. If you remember, if you have borrowed any loan from directors, under borrowings you will show that separately. If you have given any loan to directors, that will be shown separately under loans and advances. And any advance tax, net of provision for tax, this also should be shown separately. Okay, I hope you all are very clear with this. So this is what is the balance sheet phase and notes to accounts for that balance sheet. Preparing balance sheet alone is not enough. We should also prepare P&L, statement of P&L as per schedule 3 format, guys. Just this is one point which I want you all to remember. In schedule 3, actually, if you see in schedule 3, there are 3 divisions: division 1, division 2, division 3. Okay, division 1 is applicable for companies following AS, which you have learnt in your intermediate. IGAP, it can also be called as IGAP. Wherever you see IGAP, it is a normal AS which you are learning in intermediate. Division 2 deals with presentation of balance sheet for Ind AS companies, which you will be learning in final. Ind AS companies which are not NBFCs. And division 3 is applicable for NBFCs following Ind AS. In Ind AS, there will be a lot of changes in the format. You will have something called other comprehensive income and all, OCA and all. So that is why for IGAP companies, division 1 is applicable. What we are learning here in intermediate level is division 1 to schedule 3. Okay, division 2 is applicable for Ind AS companies which are not NBFCs, and division 3 is applicable for Ind AS companies which are NBFCs. Okay, what we are learning here is division 1. Let us go to P&L now. Same way, we will read the item, we'll go to the respective note and see what is there. Revenue from operations, guys, remember, this is your core business income. Basically, this is your core operations. Whatever is your core operations, from that whatever revenue you are making, that is called as revenue from operations. Whatever core revenue, it can be from sale of products or it can be from sale of services. So products revenue should be shown separately, services revenue should be shown separately. This is what will be given in note 12. That is why I'm not going to note 12. Okay, then any other income, all the incomes other than from your core operations. Sir, you tell me any examples, sir, what can come in other income? The best example, simple, best example is profit on sale of PPE. Because selling PPE is not your core business. That cannot come under revenue from operations. That will come under other income. That will come under other income, like this profit on sale of PPE. Interest income. sir, interest income revenue from operations la varalame sir. That will come only for bank or NBFCO, because for them that is the major business. Assume I am a trading company, I buy goods and sell goods, I have some extra cash. That extra cash I have invested in fixed deposit. Now whatever interest income that I get from that fixed deposit is not a part of my revenue from operation, because my core operation is not placing fixed deposits, it is doing trading business. So whatever interest income comes, that will come under other income. In the money interest income, profit on sale of PPE, any discount received, guys, forex gain, AS11 forex gain will also come under other income. Okay, so other income la adala kamikno. I will show you note 13 what it says. Note 13, if you see note 13, profit on sale of machinery, rent received, because generally rent, if it is your core operations, show it under revenue from operations. No sir, in my building I have some extra space, so side I have given somebody to it, side I have given it to somebody on rent, I am receiving rent from that. Now that is not your core operation, so show it under other income. Discount received, transfer fees. This transfer fees is nothing but whenever you are transferring your membership to somebody, you will collect something called as transfer fees. That is also not a part of your core operations, show it as a part of other income. Okay, so be clear as to what should come in revenue from operations, what should come in other income. Remember, only your core business operations or income should come under revenue from operations, which can be sale of products or sale of services. Now let's get into expenses, guys. In that, first three are very important. You should conceptually understand what they are. Okay, now see, we all learned this in AS2. Inventories will be at three levels: RM, not FG, 1 minute, WIP, which is work in progress, and FG. Correct? This material stage la irukku, innu edu processing ஆரம்பிக்கல. We have started processing but not completed. This represents finished goods or goods on which production has been completed. Okay, now let us keep this in mind and understand what these three are. Remember, listen, cost of materials consumed. Okay, sorry guys, before getting into this, all these three, RM, WIP and FG, will be there only in manufacturing companies. Okay, but FG will be there in trading companies. Only FG will be there, because trading companies will just buy and sell, they will not do any processing. But only manufacturing company will buy raw materials and process that. So in a manufacturing company, all the three will be there: raw material, WIP and finished goods. But in a trading company, they will not have raw materials, they will not have WIP, they will have only finished goods. Remember this point carefully. First one is cost of materials consumed. Sir, how to calculate this? Listen, opening stock of raw materials, you take opening stock of raw materials. To that add purchases of raw materials, and then subtract closing stock of raw materials. Sir, this looks like that cost of goods sold formula, sir. Ama, ana idu only for raw materials. This is not cost of goods sold. This is COMC, cost of materials consumed. You should take only opening stock of raw materials plus purchase of raw materials minus closing stock of raw materials. Whatever comes, that should be shown under cost of materials consumed. Okay, so first one, this will come only for manufacturing companies, not for trading companies. Sir, why sir? Because for trading companies, no raw materials, only finished goods will be there, because they are not involved in any processing, they will just buy goods and sell goods. Is that clear, everybody? Okay, next, purchase of stock in trade. Remember this one. Stock in trade means those goods which you are just buying and selling. This will come in a company which is involved in trading. இது manufacturing company வராது. Stock in trade அப்படின்னு எங்கேயாச்சும் பார்த்தனா, if you see stock in trade somewhere, that means Those goods you are just buying and selling. You are just a trader. That is why in the name also it is there. Stock in trade. That means you are just buying, selling. You are not doing any processing. So this will come only in a trading company. So whatever stock in trade you have purchased, you will put under purchase of stock in trade. Guys, remember this first one, cost of materials consumed, will come only in a manufacturing company. This purchase of stock in trade will come only in a trading company. And the last one out of these important three items is change in inventory of WIP, finished goods, and stock in trade. Sir, what is this, sir? Change in inventory. It is nothing but opening stock minus closing stock. What is this? Opening stock minus closing stock. Sir, edoda opening stock minus closing stock, sir? WIP oda opening stock minus closing stock, FG oda opening stock minus closing stock, stock in trade oda opening stock minus closing stock. The total should come here. If it is positive, it will be plus. If it is negative, it will be shown within brackets as minus. Remember that. What you should do? Opening stock minus closing stock. Sir, can you tell me conceptually? In our 11th standard, we used to prepare trading account. In trading account, what we used to do? We will write two purchases, and then above that we will have two opening stock, and then we will have buy closing stock. Correct? Now remember, assume you are a trading company. This purchases of stock in trade is coming here separately as purchase of stock in trade. In the purchasing, what is coming here is in the change in inventory. What is coming there is this opening stock minus closing stock. So how you should see is, listen here, listen, this is important to understand conceptually also. How you should see this is purchases. This is plus opening stock minus closing stock. Basically, na enna pandrena, opening stock plus purchases minus closing stock. If I do, I will get cost of goods sold. That I'll compare with revenue. I'll get paka profit. In our trading account, we used to show opening stock on debit side, closing stock on credit side. Here it is vertical format. We don't have debit credit. So instead of showing opening stock and closing stock separately, we will show something called as change in inventory, which is opening stock minus closing stock. That opening stock minus closing stock, if it is positive, add it along with these expenses. If it is negative, it should be subtracted. It should be subtracted. Is this very, very clear? So please ensure you understand these three items clearly. Cost of materials consumed, we will take only opening stock of raw materials plus purchase of raw materials minus closing stock of raw materials. In purchase of stock in trade, we will take only stock in trade of the purchases. This is applicable only for a trading company. And then in change in inventory, we will take FG, WIP, stock in trade. FG and WIP will come for manufacturing companies. Stock in trade will come for trading companies. Either the opening stock minus closing stock will be considered. If it is positive, add it along with the expenses. If it is negative, it needs to be subtracted. Clear? Everybody able to understand this? Deivame onnu mattum nalla nyabam vechuko. In the change in inventory, when you are doing, you should not take RM. You should not take raw materials in this change in inventory. Please keep that point very, very clearly in your mind. While taking this change in inventory, raw materials should not come. Sir, why, sir, raw materials should not come? What is the logic? Daivame, already in cost of raw materials consumed, you have already calculated opening stock minus closing stock. So again, if you bring it in changes in inventory, it will become double counting D. So that is why that raw materials will come in cost of materials consumed. FG, WIP, stock in trade, or opening stock minus closing stock will come in changes in inventory. I hope this is very, very clear. Please ensure, if you are slightly confused also, watch this again. If you still have an issue, please reach out to me. It is very, very important to understand these three items perfectly. This is the core of P&L in a company form of accounts. Okay. And then we have employee benefit expenses, basically AS15. Whatever we give to employees will come here. Sir, what is there in note 15 for AS15? Wow, what a coincidence. AS15, note 15. Note 15 left. Whatever salaries, wages and bonus that you're paying to your employees will come here. And whatever contribution that you're doing to provident fund, you would have seen your tax contribution to PF, employer's contribution, employee contribution, that will come here. And then staff welfare expenses for staff, if you're taking them on a trip, you're giving them lunch. Okay guys, remember one thing, in this contribution to PF and other funds, employer contribution will come here. Employee contribution will not come separately, it will be already a part of salary. ஏன்னா எம்ப்ளாயியோட கான்ட்ரிபியூஷன் எப்படி சேலரியிலேருந்து they will take and give. So employees contribution will come as a part of salary itself. Employer contribution will come separately under contribution to provident and other funds. Okay. And then we have finance cost, which is basically our interest expense under AS-16. And then depreciation, amortization, which you are charging for your PP and intangible assets will come. And then we will have other expenses. We will see this note 16 and 17 after this. And once you do, we will have profit and loss before tax. And then whatever is the tax expense, you should take both current tax as well as deferred tax, subtract that, and then you will have profit after tax. I hope this is very, very clear. Let us once see this note 16 and note 17 alone. With that, we'll be done with this format. Under finance cost, interest on borrowings will come. Here one more point I want to add. You all would have learned in DT section 234 ABC interest. Okay, whatever section 234 ABC interest that you pay also, that should also be disclosed under finance cost. Okay, keep this point. Then under other expenses, if you are incurring any other expenses in factory, some processing charges, material cost matunda will come, any other processing charges, those will come here. Factory expenses, any selling expense, advertisement and sales promotion expenses, any admin expenses, CEO salary, CFO salary, finance team salary, or office rent, those will come here. Rent will come separately, but any other administrative expenses will come under other expenses. Any consumables, nut, bolt, stores, spares, all these will come as consumables. I have used these wordings because these wordings will be there in the questions in your study material. I have gone through all the questions and I've ensured that whatever is there in all the questions is coming somewhere in this format. So please ensure you go through this format very, very clearly. And then preliminary expenses, any bad debts will come, discount allowed, rent rates and taxes, whatever rent you pay will come here. AS-19 or operating lease rentals will come here. And then commission and trade expenses, advertisement charges, insurance charges, transit insurance charges, laundry cost, this is there in one samda. Any repairs, director pay pandra fees, and any freight or carriage, that also will come under other expenses. So these all should come under other expenses. Ensure you go through this properly. Okay, now I want to discuss few interesting adjustments in your textbook. Okay, let's go to that. Guys, lot of theory will be given. Okay, this you can go through in the end, but first focus more on sums from a revision perspective. And you remember I was telling you about the new amendment aging schedule. This is that actually the aging schedule which they want to give now. So no longer that greater than 6 months is applicable, but still in answers they are following that. So that is why if in the question in the exam they ask that, please follow it. Okay, in illustration 2, I mainly wanted to discuss this adjustment 4. Okay, sir, now these type of sums, how we should approach first, sir? They will give you trial balance, they will give you adjustments. Sir, our 11th standard sum, yes. Okay, or foundation sum, yes. But here you have to prepare in company's format. Okay, what you do is first read each and every line item in the trial balance. Okay, mark that as P&L item or balance sheet item. I hope you know that income expense will go to P&L, asset liability capital will go to balance sheet. So read each and every line item in the P&L, mark them as P&L item or balance sheet item so that you don't forget, and then go through these adjustments. Wherever this adjustment is going to give an impact, just write that in short form. For example, this authorized share capital should come in share capital note, and this company on the advice of independent valuer wishes to revalue the land. This will affect land account also, this will affect revaluation reserve also. So like that, just note it down so that you don't miss that. See, remember one thing, whatever trial balance is given to you, that is a tallied trial balance. Then whatever adjustments are there, if you properly give debit effect for that adjustment and credit adjustment also, credit effect also for that adjustment, then automatically your balance sheet will tally. Issue will come only if you miss one of the effects. Either what you will do, you'll write debit, forget credit, or you'll write credit, forget debit. In that case only your balance sheet will not match. So ensure that you are reading each and every adjustment, writing where it should come in short form, and then start preparing P&L and balance sheet. And also guys, notes to accounts mandatory. Please, they are allocating marks itself to that, not only in this chapter but even in amalgamation consolidation also. Please ensure that you are preparing notes to accounts. I have seen recently a lot of answer books, they are not awarding marks if notes to accounts is not written properly. Even though your balance sheet is correct, marks are not being awarded. It is very, very important to write notes to accounts. Okay, fourth adjustment, this is important. Let us see what is given. Suspense account of rupees 4,000. So in trial balance, if you see, already there is something called a suspense account. Now they're explaining what it is. Suspense account of rupees 4,000 represents cash received from sale of some of the machinery acquired on 1st April 20x1. The cost of the machinery was 10,000 and the accumulated depreciation thereon being 8,000. So see, actually he sold some machinery and they received 4,000 cash. That machinery's original cost is 10,000 and that machinery's accumulated depreciation is 8,000. That means book value is 2,000. So 2,000 book value machinery, they sold it for 4,000. That means profit or loss? Think. It is profit. So how much is the profit on sale? Profit on sale is that 2,000. Okay. Now ideally how they should pass entry for this is, they should first pass cash account debit to machinery 4,000, and then this accumulated depreciation also they should transfer from accumulated depreciation account to machinery account 8,000, and then 2,000 profit on sale we have. For that they should pass the entry machinery account debit to P&L 2,000. This is how they should have passed the entries. Okay, but what these guys did, they just, whatever cash they received, they only passed one entry. They just passed the entry as cash account debit to suspense. That means they have increased the cash balance. Whatever cash balance is given to you in the question, where is the cash balance? Okay, that is there inside bank. Whatever bank balance is given, this is already including that 4K. There is no mistake in bank balance. Debit is pakka. But they have not made adjustments inside plant and machinery account as well as accumulated depreciation account. So what you should do, you should remove this suspense account first, subtract 10,000 which is the original cost of the plant and machinery from plant and machinery, and from accumulated depreciation ledger account, which is also called as provision for depreciation ledger account, you have to remove that 8,000. Remember, remove this 4,000, remove 8,000 from provision for depreciation, because I told you whenever an asset is sold, the accumulated depreciation in respect of that asset should be transferred from provision for depreciation to plant and machinery account. So remove this suspense account, remove this 8,000, guys. Please don't remove entire 172. You have to remove only in respect of the asset that has been sold. So what is the asset sold? This machinery. Adodam accumulated depreciation 8,000. Remove that 8,000 here. Remove the book value of the asset. Sorry, remove the original cost of the asset that we have sold, which is 10,000 from here. And in P&L under other income, show 2,000 as profit on sale. I am repeating, these guys have just passed one single entry as cash account debit to suspense. Now we have to rectify that. To rectify that, what we have to do? First of all, whatever is the original cost of the machinery that has been sold, remove that from machinery account, because that is sold, no longer there. Then whatever is the accumulated depreciation on the machinery sold, remove it from accumulated depreciation account. And then whatever is the profit on sale, show it separately under other income in statement of P&L. Sir, what if it is loss on sale? Then it will come under other expenses. If it is profit on sale, other income. If it is loss on sale, it should come under other expenses. If you do this, automatically your balance sheet will tally. Okay. ஏன்னா எப்படி tally ஆகும் சொல்றீங்க பாரு. Debit side la I am reducing 10,000. Okay. Credit side la I am reducing 8,000. I am reducing 4,000, 12,000. Plus profit lo 2,000 add பண்றேனா. That will go and add to reserves. So minus 12,000 credit side plus 2,000 profit. So your credit also will reduce by 10,000. Your debit also will reduce by 10,000. Automatically your balance sheet will. Okay. So this is one interesting adjustment. Okay. Next interesting adjustment is in illustration 4. Okay. Illustration 4. The interesting adjustment which I want to discuss is this paragraph. Okay. Let's read it. The equity capital on, remember this is illustration 4, page number 11.35 in your study mat. The equity capital on 1st April 20X1, guys. Here they're asking you to prepare balance sheet and P&L as on which date? 31st March 20X2. Okay, see that also properly. So equity capital as on 1st April 20X1, this means this is opening balance, stood at rupees 7,20,000, which is nothing but 6,000 shares fully paid up. So 6,000 shares into 100, 6 lakhs, and 2,000 shares of 60 paid up. 2,000 into 60, 1.2 lakhs. So this 6 plus 1.2, 7.2 is the total equity capital. The directors made a call of 40 rupees because this is partly paid, only 60, remaining 40 they have to call. So now they are calling that 40 rupees on 1st October 20X1. A shareholder could not pay the call on 100 shares. Sir, back to foundation days. Yes, a shareholder could not pay the call on 100 shares and his shares were forfeited and reissued at 90 per share as fully paid up. The directors declared a dividend of 8% on equity shares and on 2nd April 20X2 transferring any amount that may be required from general reserve. Ignore taxation. Okay, guys, remember, come here, come back, let us discuss what will happen. Now on this 2,000 shares, they have called that 40 rupees. Now what has happened? Out of this 2,000 shares, shareholders holding 1,900 shares properly paid everything. They have paid that 40. They didn't do anything. This remaining 100 shares, guys, did not pay that call money. So directors forfeited those 100 shares. Sir, what journal entry they would have passed for forfeiture? Equity share capital account. This equity share capital account will be debited with called up value. We have called totally 60 plus 40, 100 rupees we have called. for this 100 shares. So equity share capital account debit 100 into 100, 10,000. To share forfeited account. In the share forfeited account, paid up value should be there. Okay, which is 60. So 100 into 60, 6,000. Remaining will be to calls in arrears account. That calls in arrears will be 40 rupees in arrears. So 100 shares into 40, 4,000. This will be the journal entry that they would have passed at the time of forfeiture. Okay. Now these forfeited shares have been reissued at 90. I think you remember, in case of reissue of forfeited shares, Companies Act allows you to give discount to the extent of balance in share forfeited account. So to the extent of 6,000 rupees, you can give discount. These guys have given discount of 10 rupees per share because they have issued it only at 90. So 10 into 100, they have given only a discount of 1,000 rupees, which is fine. It is less than 6,000. Sir, now what will be the journal entry for this reissue? The journal entry will be bank account debit because we will receive money 90 into 100, 9,000. Then 1,000 rupees discount. Shares forfeited account debit 1,000. To equity share capital account. Sorry, 1 minute. To equity share capital account 10,000. This is the journal entry. Now there is one more journal entry that you should remember. 6,000 share forfeited got created. In that 1,000 got debited. That means the remaining balance in share forfeited account is 5,000. And all the shares have been reissued. Now whatever balance is there in the share forfeited account should be transferred to capital reserve. This is profit on share forfeiture. That should go to capital reserve. For that, the journal entry is shares forfeited account debit to capital reserve 5,000, 5,000. Okay, so this is how you have to pass these journal entries. This capital reserve will be shown under reserves and surplus. Answer la pathana. Okay, if you see under reserves and surplus, they are showing separately capital reserve. So ensure you follow these correctly. Okay. Others are normal, you will be able to handle. Next adjustment is, next adjustment which I want to discuss is illustration filer. See now, here they're giving additional information. See, trade receivables of 52,000 are due for more than 6 months. That means, how much is the total trade receivables we have? 2 lakhs, correct? In this 2 lakhs, 52,000 is due for more than 6 months and remaining 1,48,000 is due for less than or equal to 6 months. So what you should do in your notes to accounts, when you are writing notes to accounts, under trade receivables, if you see debt outstanding for more than 6 months, that 52,000 they are showing separately. Other debt 1,48,000 they are showing separately. So ensure that you give this disclosure properly. Next, one more adjustment. Fourth one. The balance of 1,50,000 in the loan account with State Finance Corporation is inclusive of 7,500 interest accrued but not due. Remember, I told you during the format, what comes under borrowings is only principal amount. So in 1,50,000, if you see, 7,500 is outstanding interest. 1,42,500 is principal. Now under borrowings, this 1,42,500 only should come. This remaining 7,500 will come under other current liabilities. So ensure you disclose it properly. and this loan also is secured by hypothecation of plant and machinery. So when you're writing under borrowings 1,42,500, you have to write in the bracket, this is secured by hypothecation of plant and machinery. Sir, can you show me in the answer? Let us see in notes to accounts. If you see here, see under long-term borrowings, loan from State Financial Corporation, they are showing only the principal part, which is 1,42,500. And then they are also writing in within the brackets, it is secured by hypothecation of plant and machinery. So that also should be mentioned. Next one. Balance at bank includes rupees 2,000 with perfect bank, which is not a scheduled bank. This is important. Okay, let us see. How much is the total balance with bank in trial balance? If you see, with the bank totally we have 2,47,000. Out of this, 2,000 is with non-scheduled banks. Remaining 2,45,000 is with scheduled banks. So in notes to accounts, you have to show this 2,45,000 separately, and you have to show this 2,000 separately. Let me show you in the answer notes to accounts. So if you see here, cash at bank totally 2,47,000. In the 2,45,000 separately with scheduled banks, 2,000 separately with non-scheduled banks. Ensure you show this properly. Last adjustment. The company had contract for erection of machinery at rupees 1,50,000, which is still incomplete. Sir, what to do for this? Guys, remember this. It's for this actually no journal entry. This is actually a capital commitment. This is called as capital commitment. That means you have entered into a contract which is yet to be completed. I have given a contract to you for constructing or for installing a plant and machinery. You have not yet done that erection work or installation work. So if you are still not doing that work, I will not record anything because you have not done the work. But I have entered into a contract with you already. In future, once you do the work, I have a commitment to pay to you. This commitment is for a capital asset. So that is why it is called as capital commitment. It should only be disclosed in notes to accounts. It should not be passed any journal entry. Journal entry pass. This is like contingent liabilities. It should only be disclosed in notes to accounts. No journal entry should be passed. So if you see what they would have done, they would have clearly shown it as a note. Estimated amount of contract remaining to be executed on capital account. Okay, this is only called as capital commitments, or you can also say this is the contract which is yet to be executed on capital items and not provided. What do you mean by not provided, sir? That means no journal entry passed. Okay, so what is the amount of contract which you have entered where the work is still incomplete and you have also not passed journal entry? That needs to be separately disclosed. Okay, so please ensure you also go through this note once. This is a part of your illustration 5. Suspense account we have seen. Trade receivables due for more than 6 months we have seen. Okay, so these are the adjustments mainly which I wanted to discuss. Don't switch it off the video. So still we are not done. There is one more point which I wanted to discuss on dividend declaration. Okay, this is there in your law syllabus also. Okay, see, actually you would have learned this in your Companies Act dividend chapter also. Whenever your current year profits, please remember this carefully, listen to this carefully. Whenever your current year profits are not sufficient, or in other words, whenever your current year profits are inadequate to distribute dividend, தமிழ்ல சொல்லணும்னா உன்னோட இந்த வருஷம் ப்ராஃபிட்ஸ் வந்து டிவிடெண்ட் கொடுக்கிறதுக்கு பத்தல, current year profits are insufficient to distribute dividend, then you will go and take from the past accumulated profits and give dividend. That is only called as distribution of dividend from reserves. If you read somewhere, Adana sir, distribution of dividend from reserves, that means your current year profit is not sufficient, so you are using your past accumulated profits, which is reserves, to distribute the dividend. Okay, so that is only called as declaration of dividend out of reserves. Now in this case, Companies Act is telling, when you are going to take reserves and you are going to declare dividend, that means there is something a problem. Your current year profit is not sufficient. You are not earning sufficient profits. So Companies Act is telling, you take from reserves and give dividend. I am okay, but I have three conditions which you have to satisfy. You satisfy these three conditions and then do it. I am okay. What are those three conditions? Companies Act says rate of dividend is whatever rate of dividend that you are declaring should be less than or equal to the rate of dividend that you have declared in the last 3 years. Okay, we will be doing a sum on this also. For now, I'm just telling these conditions. This is first condition. The dividend rate should be less than or equal to the rate at which the dividend was declared in the last 3 years. Average rate. You should take last 3 years ka dividend rate, calculate average of that. Current year dividend rate should be less than or equal to that. Then whatever amount you are withdrawing from reserves, that amount should be less than or equal to 10% of the total paid up capital and free reserves. Free reserves means your general reserve, P&L, personal account, all that are free reserves which are available for distribution as dividend. Sir, can I take securities premium? No, securities premium is not a free reserve. Securities premium is only a free reserve for the purpose of buyback. This is for the purpose of dividend declaration. So here securities premium is not a free reserve. CRR is not a free reserve. Capital reserve is not a free reserve. Revaluation reserve also is not a free reserve. Statutory reserve is also not a free reserve. So whatever amount that you are withdrawing from reserves for the purpose of this dividend distribution, that should be less than or equal to 10% of the paid up capital and free reserves. And after withdrawing, the reserves balance should be, remember here, greater than or equal to, first two less than or equal to, here it should be greater than or equal to 15% of paid up capital. Sir, confusing sir question. Let us see a question, then you will get more clarity. This question was asked in Jan 26 exam. So I'll open the suggested answer. We are going to solve Jan 26 sum. One minute, guys. Question number 6B. Okay, let us do this question. The following figures have been extracted from the financial statements of MC Limited for the year ended 31st March 2025. Issued, subscribed and paid up capital. So they have 40 lakhs of equity share capital and 12,50,000 of preference share capital. And under reserves and surplus, they have securities premium reserve, capital reserve. Remember, these two are not free reserves. Capital redemption reserve, sorry, this is also not a free reserve. General reserve, this is a free reserve. And then current year profit is 2,25,000. The company has an impeccable record of paying dividend to its shareholders since 2019-20 and declared equity dividend as under. Equity dividend paid in the last 5 years they have given us. Guys, it is only to confuse you. For us, what is only relevant? Last 3 years. So only this is relevant for us. Okay. Constrained by inadequate profits during 2024-25, the management of the company proposes to declare a dividend of 12.5% out of its reserves. you are required to ascertain the amount that can be utilized by the company out of its reserves in accordance with company's distribution of dividend out of reserves rules 2014. Let's do this calculation. First condition. Let us calculate what is the average rate in last 3 years. Last 3 years average rate is 12 plus 13 plus 14 by 3. 25, 39, 39 by 3. 13% is the average rate. That means whatever dividend you are declaring, the dividend rate that you are declaring the current year, that should be less than or equal to 13%. Now how much we are planning? We are planning for 12.5, which is obviously less than or equal to 13%. So first condition satisfied. Okay. Now second condition. Okay. Guys, before going to second condition, we have to do one calculation. How much dividend our company wants to give? 12.5%. Sir, I have one confusion. This 12.5% I should apply on what value, sir? Remember, you should apply this on equity share capital value. Dividend percentage should be applied on equity share capital value. How much is equity share capital value? 40 lakhs. So 40 lakhs into 12.5%, which is nothing but 40 lakhs into 1 by 8. So totally I want to give a dividend of 5 lakhs. But I have a current year profit of only 2 lakh 25. Sir, above 5 lakhs you want to give. Current year you have 2 lakhs 25 profit. So 5 lakhs minus 2 lakh 25. 2 lakh 75 is what you will take from reserves. If you think like that, you are wrong. Why, sir? Net profit for the year அப்படின்னு மொட்டையா கொடுத்தாங்கன்னா, this is net profit after tax before appropriations. That means this 2,25,000 is before subtracting preference dividend and before subtracting equity dividend. You have to be careful. Before subtracting preference dividend and before subtracting equity dividend. And when you want to give equity shareholders dividend, first you should also give your preference shareholders. So what is the calculation that you have to do is net profit 2,25,000 less preference dividend on 12,50,000. 8% is the dividend rate. So 8% into 12,50,000 will be 1 lakh. So profits available for giving equity dividend is only 1,25,000. How much you want to give totally? 5 lakhs you want to give to your equity shareholders. Out of this 5 lakhs, 1,25,000 will be taken from current year profit because only that much is available. Remaining 3,75,000 will be taken out of reserves. Now this only we have to see whether it is allowed or not. Now first condition satisfied. Whatever rate of dividend that you want to give is less than or equal to average rate of last 3 years. So first condition is satisfied. What is second condition? The amount that you are withdrawing from reserves should be less than or equal to 10% of paid up capital plus free reserves. Let us see. How much is our total paid up capital? 52 lakh 50,000. This is our total paid up capital. How much is our free reserve? We have only 11 lakh 75. So 52 lakh 50 plus 11 lakh 25 is actually 63 lakh 75,000. On this apply 10%, which will give you 6 lakh 37,500. That means following second condition, you can take how much from reserves? 6,37,500. I am taking only how much? 3,75,000. So second condition also satisfied. Now let us go to last condition. Third condition says balance in free reserves after withdrawal. That means how much free reserve we have? 11,75,000 we have. From that, how much we want to withdraw? We want to withdraw 3,75,000. That means after withdrawing this 3,75,000 from 11,75,000, How much balance reserves we will have? We will have 8 lakhs. This 8 lakhs should be more than or equal to 15 percentage of paid up capital. Remember, in second condition is 10 percentage of paid up capital plus free reserves. In third condition, it is only 15 percentage of paid up capital. That means on this 52 lakh 50,000, we have to apply 15 percentage. Let me do that calculation once. Calculator. 52 lakh 50 into 15%. So 52 lakh 15 into 52 lakh 50,000 into 15 percentages, 7 lakh 87,500. So after withdrawal, my reserve balance, my free reserve balance should be at least 7 lakh 87,500. How much I have? I have 8 lakhs. I have more than what is required. So third condition also satisfied. All the three conditions satisfied. I can go ahead and jolly declare this dividend. I hope you understood this. So first, please calculate perfectly how much has to be taken out of reserves for equity shareholders. Adhukku nee enna pannum, current year net profit you take, from that subtract the preference dividend, remaining only you can distribute to equity shareholders. See how much total dividend you want to give. This is the amount that you can give from current year profit. Remaining you want to withdraw from your reserves. For that you have to satisfy all the three conditions. Clear, guys? Okay, I hope you are very clear. Okay, before wrapping up this revision video, only one adjustment I missed in your book. There's no, my memory is coming back, so let me just revise that one also, so that it will be easier for you. Let me just go back to the textbook again. Something called, in one question there will be something called as adjusted purchases. Adjusted purchase. So this is in your illustration 6. Okay, you know, illustration 6 in page number 11.45, illustration 6, in your trial balance there will be something called as adjusted purchases. Sir, what is the meaning of this, sir? What is this adjusted purchases? Remember, guys, adjusted purchases means opening stock plus purchases, opening stock plus purchases minus closing stock. So what they have given to you in trial balance itself is after subtracting closing stock. So ensure that you are aware of that. So this adjusted purchase means opening stock plus purchases minus closing stock. Only when in the trial balance you have adjusted purchases, then only closing stock can be inside trial balance. If you have inside trial balance full purchases, that means your closing stock will be given as adjustment. When your closing stock is inside trial balance, that means whatever purchase is given to you is adjusted purchase after subtracting that closing stock. Okay, ensure you are clear with this. So remember, listen to this point once. Already what is given in closing stock is adjusted purchase. Already what is given in trial balance is adjusted purchase. That means already closing stock is, already opening stock minus closing stock is done inside this. Please in the button trial balance what is given to you? Adjusted purchase. That means inside this 400 itself, already opening stock minus closing stock is adjusted. Then when you are already adjusting opening stock minus closing stock inside this, in your P&L, again you should not write change in inventory. நம்ம P&L எப்படி படிச்சோம்? P&L vertical format P&L purchase will come separately, opening stock minus closing stock will come separately as changes in inventory. Now what is given to you itself as adjusted purchases? Purchases plus opening stock minus closing stock. This only is given to you as 400. Now when you're directly showing 400 in the P&L, again this should not come separately. Remember this point carefully. Whenever already adjusted purchase is there inside the trial balance, closing stock will already be inside the trial balance. Inside that adjusted purchases, already they have done opening stock minus closing stock. So now directly in P&L, you will only show this. If you see in P&L, you will only show this adjusted purchase. You won't show changes in inventory. இதுவே நார்மல் சம்ஸ்ல எப்படி கொடுத்திருப்பாங்கன்னா, in trial balance you will have opening stock and purchases. In adjustments you will have closing stock. Then what you should do in P&L, show that purchase separately and show opening stock minus closing stock as change in inventory. But in this illustration 6, what has happened, they have given directly in trial balance itself adjusted purchase, which is already adjusted with closing stock. That is why closing stock is coming inside trial balance. Remember, when in the trial balance already there is adjusted purchase, that means closing stock journal entry has already been passed. That is why closing stock is coming inside trial balance. In that case, you have to show purchases adjusted in P&L. Again, no need to show changes in inventory. That closing stock will directly come in balance sheet. Sir, but ipdi pannalame sir. We can calculate from adjusted purchases. We can reverse that opening stock minus closing stock, calculate perfect purchases, show that, and then show changes in inventory separately. That is how you should do practically. But in this question, that is not possible, because you read the whole question and see nowhere they have given how much is opening stock. அப்போ எனக்கு ஓப்பனிங் ஸ்டாக்கே தரலனா எப்படி நான் அந்த ஓப்பனிங் ஸ்டாக் மைனஸ் க்ளோசிங் ஸ்டாக்கை ரிவர்ஸ் பண்ணி பர்ச்சேஸுக்கு மட்டும் கண்டுபிடிப்பேன். ஸோ கொஷனில் எங்குமே ஓப்பனிங் ஸ்டாக் இல்லாததுனால they have shown purchases adjusted itself directly, because in the question there is no opening stock information. You cannot reverse work and find out gross purchases. So they have shown only purchases adjusted directly in the P&L. Changes in inventory will not come, because inside this itself opening stock minus closing stock is already adjusted. That means already changes in inventory is adjusted. Clear everybody? Okay sir, apona enna solringana, if closing stock is given as an adjustment outside the trial balance, whatever purchases that is there in the trial balance is gross purchases. That purchase will come as a separate line item in the P&L, and opening stock minus closing stock will come separately in the P&L as changes in inventory. If in the trial balance itself they have already given you adjusted purchases, then inside trial balance itself closing stock will be there. இப்போ நாங்க என்ன சார் பண்ணணும்? Suppose உனக்கு questionல opening stock தெரிஞ்சு closing stock தெரியும்னா, in the purchases adjusted lane, remove this opening stock minus closing stock. Calculate perfect purchases, only show that. Then show separately changes in inventory, which is again opening stock minus closing stock. But sir, sorry, opening stock information is not at all there in the question, sir, like this illustration 6. In that case, directly show purchases adjusted in P&L. Ana daiva sedu, when you are showing directly purchases adjusted in P&L, again changes in inventory should not come. If that comes, it becomes double counting, because inside purchases adjusted itself opening stock minus closing stock is already there. Okay, I hope you are very clear with this. ஒரு क्वेश्चन பார்க்கலாமா? எனக்கு தெரிஞ்சு எங்குமே क्वेश्चनல ஓப்பனிங் ஸ்டாக்கே இல்ல சார். இங்க இருக்கே சார் இன்வென்டரி. This is inventory as at 31st March, which is closing stock. No guys, nowhere we have opening stock information, so we cannot reverse work and calculate properly purchases. So he has directly showed adjusted purchases in the P&L. In that case, please remember, changes inventory will not come. Okay, see guys, actually in Jan 26 exam they asked only dividend question. They didn't ask a balance sheet P&L question. So please, இந்த வாட்டி கொஞ்சம் இது இம்பார்ட்டன்ட், கேட்கலாம், ஏன்னா பெரிய கொஸ்டினே கேட்கலாம் பேலன்ஸ் ஷீட் P&L May 26th, since they didn't ask in Jan 26. So ensure you don't miss out. நீ ஈஸியா ஃபார்மேட்டை நல்லா go through பண்ணு, see the format very well. Okay, and then mark those important adjustments. Trade receivables due more than 6 months, that is important. Cash in bank with non-scheduled banks, that is important. Secured loans secured by hypothecation of an asset, that is important. And the suspense account adjustment already paathuko, share forfeiture already paathuko. And then ensure you are very thorough with the format. you will be definitely be able to score in this chapter. So ensure you go through this well, because since they have not asked in Jan 26, somewhere I feel they may ask this big question, balance sheet P&L, in May 26 exam. Okay, thank you so much. I'll again come back with one more revision video. Wishing you the best as always. Thank you.